Welcome back to Morning Markets on Wednesday, the 20th of April. This week we have a pension special on our podcast, so please do subscribe to our YouTube channel to ensure that you don't miss the notification. On screen you can see the key market moves from yesterday. It was a strong day for US stock markets as we had earnings reports coming out. So far the majority of companies who have reported have actually beat their earnings expectations, which is very positive and has been taken well by the market on the day. Yesterday, we also received the biannual economic outlook report from the International Monetary Fund. Why is the report important? Well, it provides an insight to the expectations of economic growth, but also inflation from a number of chief economists at the IMF. What did the report show? The report was really demonstrating or providing additional context to a number of the important topics which we've been discussing here on Morning Markets, notably the development of the war in Ukraine and the consequence of tighter supply chains and the resultant impact of higher energy and food prices. As a result, the IMF are still anticipating economic growth to expand at a very healthy rate, but at a softer rate than was guided at the beginning of the year, which isn't really to be unexpected at this stage. Global economic growth is expected to moderate from the incredibly strong levels which we saw at the end of 2021, global economic growth around 6.1%. The end of this year, it's expected to be around 3.6%, which is still an incredibly strong print. Similar levels into 2023 and then levelling off around 3.3% in 2024. These numbers are just around 1% lower than what was guided at the beginning of the year for 2022 in total. It's the countries which have got closer proximity to Russia in Ukraine in terms of supply chain linkage, which are more adversely impacted. Countries such as the US, which have greater independence in terms of energy supply, are expected to fare better. So economic growth is expected to be around 3.7% for the US. In terms of inflation, the IMF are expecting inflation to sit slightly higher, given those input costs of food and energy prices, and to stick higher for a little bit longer than was initially guided at the beginning of the year. So for the developed world, around 5.7% expected for this year in terms of CPI prints, and around 8.7% for the emerging world. These numbers are expected to start to ease as we work through the year and then to next. So what's really happening about this? Well, as I say, we are expecting inflation prints to start to ease as we move through the year. A lot of that is driven by the improvement in the efficiency of supply chains, but also base effects as we compare year-on-year prints. The calculation of that will start to wash through to lower inflation prints. But central banks also sit in the spotlight in terms of cooling the demand side in the economy. Demand is still running incredibly hot at this point in time. And they'll do this through tightening liquidity. To tighten liquidity, they are raising interest rates, as we've seen from a number of key central banks so far, but also reducing the amount of bonds which they're purchasing from the market and holding on their balance sheet. So what does this mean for our investments? Well, a moderation in what is a very strong economic growth print which we haven't seen for many decades, are expected, and inflation is expected to sit slightly higher than what we've seen in the past. But this is not unsurprising at this point in time, given the situation which we have within Russia and Ukraine. But we are expecting those prints to start to ease as we move through the year and into next. Here at True Potential, we continue to work incredibly hard with our fund manager partners to manage portfolios in a way which best defends those headwinds and captures the opportunities available for investments. Thank you very much for watching. Please do tune in tomorrow for our update on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.